afternoon to everybody listening to our first webinar for the year 2022, 1st of February. And on behalf of the Brentis Group, I'd like to welcome our distinguished speakers from all around the world. From London, Glyn Owen, who runs our very successful Brentis Global Balanced and Global Equity Funds, has been doing that for more than 10 years. So to Glyn, we say good day, and we'd like to hear his views on markets and the views on South Africa from the London capital. And then to Magda Wierzycka, who's now in Cape Town for a while. She's the chief executive, I beg your pardon, she's now the chairman of Signia, founder of Signia, and I'd like to hear from what she's been up to over the festive season, some new funds, some new initiatives. Magda is always ready with some very exciting stuff. And then lastly, but not the least, Mike Schüssler, the consulting economist to Brentis and its clients. Mike is well known for his very independent views. He's not influenced by big commercial interests, and he tells it as it is. But there's a little bit of a background to my story today. You know, we have to go back in time almost 2 years ago. You know, February, January 2022, the world was sailing on very calmly. You know, it was a new year. There was lots of optimism in the air. And then suddenly we started hearing these reports from obscure little towns, cities in China that we've never heard of, about some kind of a strange virus that they picked up. And as these stories kind of accelerated, we at first laughed it off and said, we're not scared of any virus. We've seen them before, the SARS virus and all the other viruses that have come and gone. But this time it was different. This virus went viral, as they say, if I may use that expression, and it launched an unprecedented time in the history of the world. I don't need to tell you, the world was basically shut down by this virus. The economy came to a standstill, and governments introduced all kinds of legislation, regulation, and clamped down on its citizens all around the world, trying to contain this virus. And we are still living with the consequences in one way or the other of this virus. First of all, the stock markets went into a free fall, the sharpest drop since 1987. Markets went down between 30 and 50% in a very short space of time, as governments interfered and large parts of the world economy was shut down. But then, surprisingly, stock markets started reacting to the massive fiscal and monetary intervention by governments all around the world. Money was being pumped into the world. Interest rates were dropped. The US Fed created humongous amounts of money to rescue the planet's economies of the world. That's the way I can put it. And since then, world markets have had a phenomenal run and unleashed all kinds of things. And since April, around about 20th of April, markets until the 31st of December 2021 had one of the best and the sharpest rises in value known for a very, very long time. At the same time, we also had massive speculative forces at play because there was so much money floating around. People were stuck at home. Instead of going out spending the money on skiing trips and plane trips, they were at home playing the stock market. So we had the rise of the Robin Hood investors who thought it was very, very easy. So the speculative element in the global economy crept in, and that started coming down as well during the course of the year. But just as we thought everything was fine, we closed our laptops on the 31st of December 2021, we went our merry way, markets suddenly changed. And I was reminded of that old famous saying by Mike Tyson, and everyone has a plan until they get punched in the face. And many investors around the world have been punched in the face. And we've had a January, bloody January, as I call it. And you'll see across the world, most asset classes took a tremendous hammering. US bonds down 3%, developed markets ex-SA down 4%, US large caps down 7%, emerging markets, South Africa included, down 8%, REITs 9%, Nasdaq 10%, small cap 17%, And even Bitcoin, which was supposed to be an alternative, a safe alternative to fiat currencies, could not escape this downdraft. And the SPACs were down 45%. Biotech, one of my favorite sectors for a very long time, down 47%. And even Cathy Wood, who made a name while it going was good, her fund has lost 52% as the speculative wins in the economy started retracting. And this, was, of course, was all based on the fact that the American Federal Reserve has said that the days of free money is over, and we're going to start withdrawing money from markets, and that is creating a lot of uncertainty in markets. Even the Bitcoin people, the crypto people, if they call them, I mean, look at it. I mean, most of those names, I do not even know what they do. We all know about Ethereum, Bitcoin, maybe Solana, crypto, etc. You'll see that some investors who thought that was a safe way to protect your capital have endured enormous losses, and it might not be the end. I'm using in this slide, ladies and gentlemen, the S&P 500 ETF, which has had a phenomenal run over, what is that now? That is over 30 years now, 30 plus years with downturns. But since the end of the great financial crisis, 2009, it has been a phenomenal place to put your money for investors all around the world. South African investors came into this at a very late stage, but you've had a tremendous run. The big question now is, and hopefully people like Magda, Glyn, and Mike can answer that, is this the end of the bull market? Is it time to change investment strategies? One can see, for instance, not only the S&P 500, in a more aggressive space, NASDAQ had, since 2009, a run of almost 1,500%. If you break it down in annual returns per year, there's been, I think, 1 year that it didn't make money, and that was 2022. So since 2009, in the NASDAQ, any of the big companies, the FANGs, the big tech stocks, being the place to be. The question, is that party over? Already we see signs that tech stocks may, for the first time in 13 years, underperform perhaps more value-oriented stocks. It is something that Brenters debate endlessly. We're following this very, very closely. There has been a downturn of about 15 to 20%. It may, however, be the time to be buying. We don't know, but we need to follow the facts and what they tell us. What we do know is that the longer you stay in a product like the S&P 500, over time, you have a better chance of making money. Short term, you could lose money, no question about it. But for any long-term investor, history shows if you have a holding period for 1 year or greater, you'll have a chance of between 75 and 100% to make very, very good returns. That's what that chart tells you. What we've seen, of course, after months and months and even years of very low volatility, in other words, fear. There was very little fear. Markets only going to go up, so you close your eyes, you put your money in the market. We've had a return of fear. The volatility index, as measured by the VIX, huge jump in December and in January, which in some cases is seen as a good thing. People are now afraid of markets and are very more selective in their choices of asset class. Just a repeat of it, going back further in time, we can see that the markets were incredibly calm, and then suddenly the fear started coming back into the market. Some people, some analysts see this as a contrary indicator, normally the time to be buying, not to be selling after such an event. Well, just to end up my side of the story, going through a couple of interesting charts, which even I didn't know. If you start, of course, the big debate in markets, and we have this debate for a very long time, the value style versus the growth-orientated style. Now, the value style, popularized by Warren Buffett, etc., have not had a good time for 13 years. In fact, since 2009, the growth and the momentum style stocks have been the winners. But we are in an area where we've now had two signals. You see number 1 and number 2 in yellow on the right-hand side of the chart. saying maybe, but just maybe, now is the time to start rebalancing your portfolio. And to clients of renters, we are looking at this and we'll be making recommendations in due course. But a very interesting slide shows you how long value stocks have been out of favor, and we might just see a major turning point on this. On the local side, I might add an investment fund manager like Petfillion, who runs the Counterpoint Value Fund, has had the best 5-year period on the local market, and he is out and out a value style manager, and he sticks to his style. He says, now's our time. And there are other fund managers in South Africa and also abroad who are rubbing their hands and saying, this is our time to shine. Now, here's a very, very interesting chart, probably the most important one as it refers to South Africa. As we know, and Mike, maybe you can comment on that, the South African stock market is very strongly correlated to the commodity cycle of the world. What the commodity cycle does influences our trade balance, imports, exports, and hence the stock market and also the exchange rate. And then you can see very clearly that since 1980, on the left-hand side of your chart there, the market, the cycle peaked. That's about when I started in this business. I came into the financial services industry when commodities were booming, gold was booming, diamonds were booming. Everybody thought it was easy to make money. Lo and behold, the markets turned around, started retracting, and we had a very, very long bear market in commodities, and our market underperformed very dramatically against world markets and also the currency. 2001, we suddenly had the reversal. China was allowed into the World Trade Organization, and they started buying up everything that we could dig out of the earth here in South Africa. And we had a massive, massive boom. Rand strengthened down to 5.50 Rand. Stock market was the place to be. Returns of 30 to 40% commonplace. So for 4 or 5 years, South Africa was a phenomenal place to be in our mining stocks, in our commodity stocks, and virtually every other stock you could find, property, you name it, you made a heck of a lot of money in South Africa. 2008 turned around, very, very sharp drop, small recovery. But since then, 2011, 2010, we've had a downturn in the commodity index, which has heavily influenced our view on the Rand and offshore versus onshore. So for the last 8 years, 9 years, we have been underweight SA equities and overweight offshore equities with great results for our clients. However, now comes the big question, and that's again the $1 million question, or maybe it's the $1 trillion question. We had since April 2020 one of the sharpest upturns in the commodity cycle in the world. In fact, I saw one analyst saying it's the sharpest upturn in 50 years since April 20 to now, and you can see it, how sharp that gradient is, and it has just taken everything along with it. And the reason for this upturn was the massive amounts of money floating around the world that was being pumped into economies, the United States in particular, Europe and China, to get the economies going. And what do people, especially the Americans, do when they have money in their pocket? They spend it. Hence, we have supply shortages of microchips, and the price of virtually every single commodity that you can find just simply went through the roof. At the same time, we also started seeing US Treasury rates signaling higher interest rates, but until now, it hasn't made a big difference to the spending by the American population. I don't have the chart in front of me, but if you look at what the average commodity has gone up, we're looking at oil up 100%, lumber, which is wood, 70%, copper, iron, steel, pecanut oil, you name it. Everything but everything just surged through the roof. There's not enough capacity on the ships or container ships. They're making record profits. Nobody talks about that. Everybody focuses on the medical companies and healthcare companies making record profits, but the shipping companies are making even more money because of this massive demand coming from the United States, and hence the fact that inflation in the US has, after 25 years of very benign inflationary periods, inflation has jumped to 7%. The big question, is this going to be semi-permanent, or is it going to be a short-lived uplift in inflation as the US Fed calls it transitory, and will it start declining at the end of the year? This has enormous implications for South Africa, the currency, the balance of payments, etc. So, is there a trap in hard assets? This is what I was referring to, heating oil plus 69. You can see these facts later on our website. The only thing that hasn't done well in this period has been gold and silver, which has declined quite considerably. So the questions to end off: is the bull market over? Is there a move from growth to value? How much will the US Federal Reserve increase interest rates? Is it going to be 5, 6, or 7? How durable is the US inflation? How far can the commodity cycle go? What is the outlook for the JSE and ZAR? And the exchange rate over the next year? And lastly, is the boom in technology shares over? That sets the background, ladies and gentlemen, investors listening to this program, what we are faced with as investment advisors, asset managers, and those are the questions that each and every investor must ask and answer for himself. And with that, I'll hand you over to Magda Wierzycka from Signia. From me, it's goodbye until later.
Thank you, Magnus. Hopefully everyone can see the slides. So, well, again, welcome to Brent's webinar. I'm very privileged to once again having been invited. I only have 20 minutes, so I'll try to be brief. I'm not going to repeat what Magnus has already said. I think, what he has said makes a lot of sense. I think there are, questions that need to be answered in terms of, where we are heading into 2022. But, I don't want to just go on repeat of what everyone else is saying about the markets. I actually want to take you on a bit of a longer term journey. I will touch on the markets and I'm happy to take questions, but, I have been involved in the venture capital markets and investing in venture capital companies through the Signia OSI fund for the past couple of years. And what I've come to realize is that the world out there is much bigger than what we see here in South Africa. And that really is my kind of next chapter in terms of focus and evolution. So not everything that we are seeing is doom and gloom. So yes, we have seen the market sell off in January, post an incredible bull run. But, the world is bigger than just listed investment markets, which is really what we are talking about or we are concerned about most of the time when looking at savings. So just looking at 2021 through a different lens, not through the lens of listed markets, but through the lens of innovation. We have had multiple safe, effective, novel vaccines based on brand new technologies of mRNA, reaching billions of people in the shortest history of time in the pharmaceutical industry. It has been incredible. It also has been a historic year for space exploration. So we're not talking just about, some drones and rovers and telescopes, but it has been a year of the first space tourism. And that option is now offered by multiple companies. It has been a year of innovation in nuclear power and in the search for fusion. As record amount of private money has flown into that space, and by private money, I don't mean individual investors, I mean institutional investors, because everyone recognizes obviously the impact of climate change and the need for an energy mix which is climate friendly. We have had incredible innovations in the space of artificial intelligence and future drug discoveries with the DeepMind's AI system, which can now predict the protein 3D structures And that is, means that you can start working towards drug discoveries using artificial intelligence, working backwards from the structure of protein. And again, that has deep implications for the speed at which drugs can be developed and the effectiveness and cost of those drugs. We have had incredible progress in quantum computing. And with Google's quantum supremacy experiment now surpassed by 6 orders of magnitude. So that's where, that's the proof that a computer built around quantum mechanics as opposed to bits, classical bits, can carry out calculations exponentially faster. And then synthetic
May I just interrupt? There's a problem with your slides. Carry on, but we are trying to fix it in the background. So
okay.
You need to share your screen, I think. Are we getting questions?
I have shared my screens. Hold on, let me just try it again. Apologies for this. I thought we were sharing the screen, but all I can see when I'm sharing.
There we go. Got it. Thank you.
Are we there? Okay. Excellent. Everyone happy? Okay. So synthetic biology startups have begun to disrupt petrochemical-based manufacturing. Again, it means a greener, better future. And it's the sign of the times that Elon Musk was named Person of the Year by the Times magazine. Now, obviously, before I go into my next section, which is the private markets and not the public markets, we do have to look at what's ahead in 2022 and what has happened. And really, yes, we have had a very low start to the year. As Magnus said, S&P 500 index down 7%. And the sell-off started literally on the 1st of January, 2022. So what has changed? I mean, really, you can boil it down to one issue, and that is inflation, which hit 7% in the US in December. And the big question mark is that inflation transitory or is it permanent in nature? And how and when will the Fed respond? So when you look at inflation, there are basically 3 sources right now. There is the demand-driven inflation, so strong consumer spending, full employment in developed markets, increasing wages, so people are spending. We have supply chain problems, hence the prices of secondhand cars have shot up, food prices are up, metal prices are up. And the only, real issue, which is a left field issue, and that's the geopolitical risk around natural gas prices, Russia versus NATO versus US. And that's a real risk, which I think, we all have to watch for and see what unfolds, because should anything happen, which I don't actually believe will happen, but should anything happen, then obviously the markets are going to crash. When they crash, by the way, it's the greatest buying opportunity ever. So not always negative. Right now, in terms of market valuations, the market has dropped off and it's pricing in about 6 US Fed interest rate hikes this year, starting from March. And we have had some indications that the Fed intends to, and obviously they've signaled that they intend to increase interest rates. China has increased interest rates by 25 bips. EU has indicated likewise. But guys, we're sitting in the world of negative yields and almost 0 interest rates. So even if those interest rates are increased, it's not going to be significant. But what you are hearing from all the central banks is that they have every intention of managing inflation. That's why we don't actually think 2022 is going to be a year of panic. Definitely higher inflation dampens returns from equities and bonds, but we believe that it will be brought under control relatively quickly. Global growth prospects remain very healthy. US equity valuations are high, but again, if you look under the bonnet, you need to understand that 5 stocks, tech stocks, make up 23% of S&P 500, and that is what has driven the returns in particular last year. So again, it talks to the fact that there is a bit of a rotation going on from growth to value. We don't believe central banks are going to hike interest rates too aggressively. Inflation will moderate. OPEC has agreed to increase crude oil outputs. So, all the good signs pointing to the fact that inflation will be managed. Asian tech stocks, obviously Naspers process being affected the most on the South African Stock Exchange, definitely have been oversold. I mean, China really is looking for this policy of common prosperity. So it was important for them to take down a couple of visible figures which represented enormous wealth accumulation, like Jack Ma. And hence, but that doesn't talk to the economy of China. The economy remains, again, incredibly healthy. But in the space of, listed markets, there is an acknowledgement that probably the period of extraordinary returns is over. And we are moving into a more kind of, not necessarily flatlined time, but certainly not the type of returns that we have experienced over the last few years. And hence, large investors internationally are looking for excess returns from alternative investments. And there is a huge amount of money that is currently moving from listed or public markets into private markets or private companies. So just to give you an idea of what's happening, and private markets, and companies which are unlisted usually are called, companies which fall within the venture capital investing space. And, over the last year, the number of deals, or basically this is where startup companies and other companies which have no revenue, so they are still growing, they're innovating. So this is literally innovation. Those companies have raised, we've seen, 32,000 deals globally, up from 28,000 in 2020. But more significantly, the amount of money that has shifted, and that money has shifted from, listed markets to unlisted markets. The capital invested in those private companies has doubled, from $361 billion in 2020 to $686 billion. And what is happening is that those companies are being valued at 2 times the valuations of 2020. Europe, in terms of venture capital markets, so startup companies and innovation companies in Europe have lagged behind the US for a long time, but that is starting to change. Again, just talking to the investors in Signia OSI Fund, over $100 billion of capital was invested into private markets in Europe. So it's 3 times the amount invested in 2020, most of it in the UK. So why is venture investing, private market investing, rather than listed market, the new it? Part of it is the money that is being made. If you look at, if you look at exits, and when I talk about exits, that I'm talking about private companies which either listed through IPOs or have been acquired. So the proceeds from these kind of what's called exits have shot up from between 2020 and 2021. So this talks to the value that has been created in the private space. So the number of listings increased by 42%, capital raised increased by 174%. So there has been a huge value creation from VC-backed companies. In fact, that value creation has been $754 billion. And Europe's share of these exits has doubled between 2020 to 21, again, largely driven by the UK. And now, this is not a new phenomena. If you look at the current listed markets, 7 of the top 10 largest companies in the world, including your Googles, your Facebooks, your Amazons, were backed, began life actually as VC-backed companies, and they are technology companies. And today, 5 of these run into valuations of trillions of dollars. From our perspective, we believe that this trend of investors investing in private markets and not just in listed markets is just beginning. So if you look at the type of returns generated by the top performing venture capital funds, and again, Signia OSI Fund invests in 2 venture capital funds, many of these funds have delivered returns of, internal rates of return of 25% per annum, or more simplistically, 5 times the return on your invested capital net of all fees. Post the world of pandemic, despite the fact that US Fed will temper the amount of money they are printing and start slowly increasing interest rates. The truth is the world is awash with cheap money. Even if those interest rates go up to 1.5%, what's 1.5%? And besides that, you can't look at absolute interest rates. You have to look at real interest rates, which we believe will remain very, very low. So you have a lot of cheap money in the world. You have very few attractive investment opportunities. Just to give you an idea, there is currently a sixth of the global debt is trading at negative yields. We are also living in a world of absolute golden age of technological innovation. So you've got innovations across multiple different sectors, from machine learning, genomics, gene therapies, quantum computing, and so on. And then, most importantly, venture and innovation is spreading around the world, way outside the borders of Silicon Valley. And VC investing is also evolving. It's becoming more like a listed market, equity investing, than ever before. So, I'll give you some staggering numbers. Basically, the styles of venture capital investing have evolved into two. Into a passive style, it's a little bit counterintuitive. Very large US venture capital funds like Tiger Global have invested tens of billions, if you can believe it, tens of billions of dollars at an absolutely breathtaking velocity in 2021. They have basically made an investment a day at a median valuation of into companies, which after the companies have raised money, were valued at close to $1 billion. So, funds like that are behaving more like hedge funds in listed markets. Once they've invested, they have very limited engagement with the management of the companies, and that's why we call it passive style of venture capital investing. The active style is more what we do at the Signia OSI fund, and that is, helping the management of companies build up their companies. So that's the active style of getting your hands dirty with the companies you invest in. There's also, another evolution, and that is that venture capital funds are evolving from being classified as, kind of investing in small startups, to investing in more growth companies, to investing in pre-listing companies. And, the funds are investing across the spectrum in a diversified range of investment opportunities. And they are investing earlier and earlier. And the reason for that is that those initial investments are the ticket to the game in terms of the future, because the best companies are no longer raising capital and begging for money. The investors are begging to invest in those companies. And the most valuable asset for a venture capital fund is no longer capital, because capital is plentiful. Cheap money is everywhere. The true advantage lies actually in having access to relationships, to the startups, and to being able to execute and invest. So why am I excited about the future? One is that, obviously we all know what's happening in South Africa. We all know what's happening in terms of pandemic. We all know what's happening in terms of global politics. But frankly, one needs to look a little bit beyond the noise of all of that. And because, if it's so easy living at the tip of Africa to get kind of bogged down and depressed by the small stuff. World is a very, very large place, and it's awash with investment opportunities. I really would not focus on short-term cyclical trends. Just to give you an idea, 70% of trading in the US markets today is driven by algorithms, not by human beings. So right now, companies with negative or a very short-term history of revenues are out of favor. So that's your kind of arc innovation. Even fourth industrial revolution had a bit of a sell-off. It doesn't matter. Long-term companies involved in innovation, new technologies are the future. And that is, I've got absolutely no doubt about it. And what's the best advice that I can give you in the times of uncertainty? And I think that I'm actually not necessarily saying anything different to what Magnus said. Do nothing and observe the world around you. Thank you very much.
Hello, everybody from London. Let me just share my screen, if I may. Bear with me 1 second.
While we're waiting for you, Glenn, I just want to thank Magda for her talk, and I think she's answered some of the questions about the Fourth Industrial Revolution Fund. There was a question about that, and I agree with you. I would not be a seller of that fund. I would be a buyer of that fund. I mean, that normally when the investors get it wrong, they sell after a downturn, and the smart people buy after a downturn. And then there was a question about OSI. What has the that fund done over the last year or so? Magda, have you got some stats for us there?
I don't have the stats. Let me just try and switch the video back on. I don't have the stats, but what you need to understand and there's a reason for it. The best venture capital funds in the world, Sequoias of this world, do not publish short-term returns. And the reason is that investments of this nature are like a staircase. You know, you invest in a company and you have to wait for the valuation of that company to go up. And that valuation uplift might take 6 months, it might take a year before the company raises money because it has done stuff. It is now more valuable. It raises money at, say, double the valuation. So instead of the returns being, you know, kind of what you used to in the listed space, which is, you know, money moving up in linearly and in a zigzag pattern and sell-offs, in the venture capital space, think of it literally as a staircase. There will be periods of plateauing and then a sharp uplift, and a period of plateauing and an uplift. And, you know, sometimes there might be a downturn, but Signia OSI Fund, you should think about as a long-term investment and something that you put into not your back drawer, but it's not your core strategy. It's part of your kind of satellite strategy. And you wait, because that's where your returns, your 5 times return of capital comes over a period of time. It doesn't come over 1 year. But just to give you an idea of what the underlying holdings where we have, you know, much greater visibility of valuations, because the shares of OSI, which incidentally has been renamed to Oxford Science Enterprises, so it's actually OSE. Shares of OSE do trade over the counter, and since we invested in those shares, they are up 80% in pound terms. So that company is becoming more and more valuable. But obviously, we also invest in the underlying spin-out. So think of Signia OSI Fund as your long-term investment with a longer-term time horizon. And then, Magnus, to your point on Signia Fourth Industrial Revolution Fund, I'm buying at the moment. Just because I think that, you know, and I'm not saying that this is necessarily the end of the dip. And they might very well be, you know, still a bit of a downside. You can never time these things perfectly. But the fact that we've had a revaluation of what I call the future is, to me, the best buying opportunity ever.
I agree with you, Magda. Thank you very much for that. And now we're over to Glyn Owen, who runs the 2 Brentis Global Funds, the Balance Fund and the Global Equity Funds, both doing very, very well for our foreign investors. Over to you, Glyn.
Thanks, thanks, Magnus. Well, Magnus, as ever, has made all the key points in his early statement, and that's all the very difficult questions. I'm going to try and answer some of those in the course of the next 20 minutes or so. I want to emphasize that 2022 is a big transitional year for the global economy, for markets, and transitional years when things go through different phases to what we've been accustomed to in the past couple of years can be sometimes pretty volatile, and that's what we're seeing at the moment. And as Magnus said earlier, the past couple of years has been totally dominated by the pandemic. We are going to move on from that, and I'm not going to dwell on the past, but just to highlight what happened in 2020 across the major markets, and then what has happened so far this year. The top blue line there is the S&P 500, so Wall Street. It was by far the best performing market in 2021. It is by some margin the worst performing market so far this year. It's had a big fall, incidentally. The bottom line is China, by far the worst performing market through 2021, and we all know the reasons why. The big regulatory clampdown, the problems in the property development area, the slowing economy. It's a huge contrast with the US. Then the two lines in the middle there, the green line is emerging markets, the red line is the world excluding the US. So those two are pretty much the same as each other, interestingly. Emerging markets have actually come down this year, but held up relatively well. Then the lines there show what gold and bonds did in a rising interest rate environment, both pretty difficult for those areas. So last year was really all about two markets, the US performing incredibly well, China really badly. This year, a reverse of that. And incidentally, although the US has started the year really, really badly, as Magnus pointed out, some markets are up. China's is down actually this year, but some parts they're doing well. The UK market is actually up so far this year. So what we're seeing here is a very, very big rotation and a big transition. The first thing I think we can pretty much put to bed is that the pandemic is over in all but name and basically moving into an endemic stage. The Omicron variant has been a great favor, I think, in the UK. Certainly, it's enabled us to move on pretty quickly. There's so many people have had this darned Omicron variant now, including myself a couple of weeks ago. There's the herd immunity built up along with the vaccinations is immense. We're now completely free of all restrictions. That's going to happen across the world. This index here is produced by Goldman Sachs. It shows the effective lockdown index. So when we went into the pandemic crisis, there was as Magnus pointed out, a collapse in economic activity. As each wave has come along, we've got better and better at handling it, and we're now coming out of it. So by the end of this year, I think we're going to be looking at endemic states. It's not going to be the influence on markets that we've seen. We're learning to live with it. It's not impacting us in any significant way. What is impacting us much more is what's happening to inflation, as Magnus pointed out, and indeed what's happening to growth. I've taken, in terms of growth here, some numbers from the IMF, the latest numbers that came out just the other day. 2022 growth, they're forecasting for the world at 4.5% or thereabouts. The long-term average is below that, more like sort of 3.5% or so. It comes after an extraordinary year of growth last year. This is going to be another good year because we've got this pent-up demand that Magnus was talking about. As we come through all these lockdowns, people have saved a lot of money. In the US, the savings rate has gone to something like $2.5 trillion, about 13% of GDP. They've got a huge surge of wealth in the US, and it's happened across the developed world because house prices have been going up, share prices have been going up. This is going to continue to boost growth, but not to the same extent as last year when the lockdowns were first eased. So a transitional year where growth is slowing down towards a more sustainable rate, but still a very good year and a good year for the corporate sector generally. And that's shown in these leading indicators that we often refer to, purchasing managers indices. A number here above 50 points to a continuing growth. Below 50 is recessionary. Well, there's what happened in the pandemic crisis. Then this great surge of growth. Now we've seen numbers coming down recently, so a little less confidence around about the future, but still very, very positive numbers for this year. So there's no signs of any recession over the next couple of years here. This remains a very buoyant environment for the global economy and for the corporate sector, albeit at somewhat slower rates. China's had some big problems and is hovering around in Chinese terms in recessionary areas, growing at about 4%, but that's still a big number on the second largest economy in the world. And we think there's opportunities there after that big fall that we saw last year. China is not uninvestable, as many people are now saying. The big question is inflation. Is it transitory or persistent? Magnus asked that very question. The Fed has moved on from calling it transitory. It's now more sustained than they were expecting, and indeed other central banks are in the same camp. So there is more concerns about this. We don't dismiss this. It's a real risk. If inflation stays permanently high like this, then you've got a real problem on your hands. This number I'm pointing to here are producer prices in indices. That started to come down, which is early days, but sort of encouraging. And we do think we're getting towards the peak of the inflation cycle here. This is not a 1970s situation when I started this business where inflation went to 20-odd%. This is just not on the cards, but it is a worry, and it's certainly caused some anxiety in markets. And indeed, the Fed, as Magnus pointed out, the really big issue for this year is what is the Fed going to do? And it's the Fed that's critical because, of course, the US is the most important economy in the world. It's the biggest. The dollar is the world's reserve currency. What the Fed does matters to us all immensely. This is a complex slide, but it shows the hawkish pivot of the Fed in the past few weeks. This is the outcome of governors' meetings that meet to determine monetary policy in the US. Each dot represents the view of a Fed governor about where interest rates are going to be at certain dates in the future. That blue line there shows the median sort of dot plot average. And what they're saying now for this year is that there's going to be probably 4 rate rises this year. Just a few months ago, these 2 lines here, in fact, even weeks ago, they were saying there might only be 1 or even none. Then for 2023, they're saying probably another 3 rate rises. Again, just a few weeks ago, substantially less than that. So there's been a distinct shift to hawkishness here by the Fed. They've got worried that inflation is becoming a bit sticky. So they're going to raise rates quicker. They're ending this asset purchase program where they pumped in trillions of dollars, literally trillions of dollars of liquidity into the markets. They're winding that down quickly. And they're also saying that they're going to actually remove liquidity from the markets soon after they start raising rates, which is going to be in March for sure. So this is a distinct change. This is the big transition happening. And the question is, can the Fed get on top of inflation without causing major eruptions? The big point I'd make here is that these are sharper rises than we thought, but under no circumstances can you regard 1.5% to 2% as high interest rates. These are the sorts of things that years gone by we'd regard as very low. And indeed, with inflation running at 7%, they are very low still. And the longer term rate, what we all call the terminal rate, is still only around 2.5%. And frankly, if that's what happens, which we think is pretty likely, that's still a pretty loose monetary environment. Tightening, so it's very different to last year, transitional phase, causing some volatility and some adjustment as the markets get used to that idea. But this is not something that's going to hold back markets longer term. Then what has happened to bond markets? Well, again, Magnus alluded to that. This is the 10-year bond yield in the United States, a very important indicator. It's currently a little bit under 2%. It's moved up a bit this year, about 30 or 40 basis points. It's still pretty low by historical measures. It's been a lot higher, as you can see. A large part of that move has occurred, well, in fact, all the move this year, frankly, has occurred because real interest rates have moved up. And believe it or not, real interest rates on 10-year bonds, if you look at the expected inflation 10 years from now, were running at -1%. Incredibly low, makes bonds very expensive and unattractive. They have moved up, but they're still in negative territory. We think that's probably going to go a bit further in the course of this year as the Fed tightens. And indeed, it would be a normal thing, as you can see here, to see interest rates positive in real terms. And we would expect that during the course of this cycle. So we're not very excited about bonds yet. In this cycle, we still think equity is going to produce the best returns. There's one other really big number I'd draw to your attention here, and the Fed will be watching this very carefully along with all the rest of us. This is this dark blue line. It's inflation expectations in the US 5 years out for the subsequent 5 years. And it's really extraordinary that despite these high levels of inflation we've got, it's been falling, that number recently. And indeed, it's well within the range of the past 10 years, if you look back further, well within that range as well. Excuse me. So this is not in any way alarming. And indeed, that's the sort of number we'd expect it to be at. The market might be wrong and it might be underestimating that, but as things stand, that looks to us not alarming in any way, shape or form. What has happened as a result of all of that is you've got this huge style diversion that Magnus alluded to. And guess what? Growth stocks, what we call long duration assets, where your earnings are down in the longer term, years ahead, as Magda was also alluding to, they've suffered pretty badly since the start of November, when this sort of hawkish tilt of the Fed started to come along. So here, US small cap growth stocks are down by over 20%. Other things have fallen sharper, as Magda and Magnus have alluded to. Excuse me. World growth stocks have done very badly, but value stocks have actually held up well. And it's the reason, incidentally, why the UK market is up this year, because the UK is stuffed full of value stocks. We've been buying the UK market for some time now, a little bit early, because it's been overlooked since the Brexit vote, and it's stuffed full of value stocks. Energy, old-fashioned energy stocks like Shell, BP, terrific. You know, they're making huge amounts of money with oil at $90 a barrel. It's stuffed full of financials. What happens when interest rates go up? Banks and insurance companies make a lot more money. Terrific. So you've got this sort of now great tailwind for these value stocks. This has got further to go, in our view. This is early days in this value move, and we wouldn't dismiss growth. We always keep a balance of styles in our portfolio, and I'll quickly show you that at the end of the presentation. But it is a time where we think value can continue to make further progress. So there's a big transition going on here too. The other thing that people are going to watch is what's happened to wages. You're going to look at inflation expectations. No alarm bells ringing there. Wages are another key thing. If people see inflation going up, they want higher wages. If inflation expectations change, then that also dramatically changes things. Yes, wages have picked up in the US. They were bottoming about 3%, but at about 4.5%, that's not unusual by historical standards. Productivity growth in the US is running at about 2%, so real wage growth of 2%, that's perfectly acceptable and sort of what you'd expect. Now, obviously, if that starts to go up like that, we're all going to get more concerned, but at the moment, that doesn't look too bad. We don't dismiss the risks, and we think you've got to keep some defensive assets to protect against that risk. The Fed might tighten more aggressively, but no alarm bells ringing on that score for us. We certainly don't see any recessionary environment around, and we do think inflation is going to come under control. And one of the reasons it's going to start falling is, first of all, base effects. Prices started moving up dramatically in the energy area, for instance, more than a year ago, so they're going to start to fade off on a 12-month rolling basis. And there are signs of some of these supply chain disruptions that Magnus talked about earlier beginning to ease a bit. The iron ore price has come down quite a long way. That's largely because China has been weak, particularly in the big property development area. That's a big consumer of iron ore, but it's been coming down. That's helpful. Shipping rates, this is the Baltic Dry Index, which is the cost of shipping dry materials around the world. That's fallen to where it was sort of before the pandemic. Container rates have not come down as much, but they've peaked and coming down a bit. I don't pretend this is easy. We notice in corporate announcements for earnings that we've seen in recent weeks, they're all talking about these supply chain disruptions. But this is a temporary phenomenon. Supply chains will correct. Semiconductors, Magnus alluded to, South Korea and Taiwan, the biggest producers of semiconductors in the world, increased production by 25% in the second half of last year. People and companies respond to these price increases we've seen and build more capacity. So this will ease. So this inflation will begin to ease as we get, in fact, we may be close to the peak, we think, in the first half of this year. Then it starts to come down. The question is how quickly, and that's why we're looking at things like wages and inflation expectations. But the Fed has already tightened policy by what it said and what it's beginning to do. So there's a degree of tightening going on, and we suspect it won't have to do more than what it's currently saying it will do. And the market is beginning to discount that. So there's quite a lot in the price. The big thing for equities is that they had a big rise, as Magda said, 2 extraordinary years, 20% per annum each year. The MSCI World Index was up in 2020 and 21, but earnings rose by more than that. Earnings were up by 50% last year. So you've seen a big drop in valuations. The US is the most expensive market, and that's partly because there's a very high proportion of growth stocks, tech stocks in there. So it justifies a higher rating. It's a very high quality market. Other markets look to us to be pretty cheap. And we're positioned in the UK and Japan. We like a lot. It's been done pretty poorly this year, and indeed for quite some period of time. That looks to be some very good value there. So valuations are supportive. And although we've had this very rocky start to markets, we certainly think they can make progress during the course of this year and will recover. I'm not going to dwell on this. I've talked about what earnings are going to do. That's the number for 2021 on the S&P 500. Next year, the consensus earnings are calling for 14% growth. It may not be quite as high as that, but it's still going to be another good year. There are some pressures on margins because of these supply chain disruptions. So it may be a 10% number, but that's the sort of thing that's going to drive markets higher from here. And just summing up quickly in the interest of time here, this is a year of really important transition. The pandemic to endemic, we can put that behind us. It's been painful, but we're out of it, or coming out of it. Definitely, we're in the stage of monetary policy tightening. We fully recognize that. There are risks around it, policy errors, as the Fed left it too late. We know all about those concerns, but it looks to us as if this big shift that the Fed has done in the past few weeks is going to be enough to bring inflation under control. Fiscal support, the emergency fiscal support, is going to be withdrawn for obvious reasons. It's not necessary anymore. We're coming out of the pandemic. But as we all know, we can see it around the world, there's no return to austerity. That's certainly the case here. There's plenty of government spending carrying on. In the US, Biden, who's been weakened quite a lot in his first 12 months, hasn't been able to get through the big part of his fiscal package, but there's still going to be plenty of spending around. So the peak growth rate is fastest, but it's going to be still a robust year ahead. And 2023 looks to us as if it could be a decent year as well. Inflation, definitely the biggest risk. That's the question that Magnus effectively posed. Can it be controlled without triggering a recession and a market crash? We certainly think it can. The Fed is moving quite quickly. Other central banks are moving towards tightening. The Bank of England is going to raise rates here in the course of the next, possibly even this week, certainly in the next month. So there's a tightening going on, but still at levels where interest rates and policy are fairly benign. China, we think, is very interesting. Some people regard it as uninvestable because of what it's been doing in the past 12 months. Common prosperity not working in investors' favor, regulatory clampdown. We think that this is all manageable for China, and actually there's some pretty interesting opportunities there. So we quite like that area. Geopolitical risks, well, as I mentioned earlier, geopolitical risks are always there or thereabouts, and there are some concerns, particularly at the moment around Ukraine. Well, Russia's got 100,000 troops on the border. You might be amused to know that we've sent Boris to Ukraine today. I think he wants to get away from Partygate and to try and sort out the problems in the Ukraine. I think it's very unlikely, incidentally, apart from Boris's boots, there are going to be no British boots defending the Ukraine against Russia in Ukraine. Neither will there be any US boots. I don't think Russia will invade, a bold statement, but I don't think they will. But if they do, it would obviously be pretty damaging short term because of the impact on energy supplies to Europe. But with some defensive assets, gold is a very good defender there. And incidentally, if you compare gold's performance against Bitcoin, for instance, that people thought would be a really good gold substitute, well, I think we all know the outcome of that this year. We must be careful of how far bond yields go up because of the impact on valuations of other asset classes. We've seen the impact of that already. And these big falls we've seen in these more aggressive end of the growth stocks point to us towards some opportunities emerging there. So it is creating opportunities. And we always think it's important to keep a blend of styles in our portfolios. And we think equities are going to provide the best return in this more challenging environment. I'm not going to dwell on these too long, but the two funds that Magnus mentioned, we manage on behalf of Brenthurst, which we're delighted to do now for more than 10 years. A balanced fund, 60% equities, strategically 40% fixed income, equity, 100% global equities. The two funds currently positioned, the balanced funds just over 60% in equities. We're going to be fairly close to that benchmark. Our commodities are gold. We've got that as a bit of an insurance policy. Equities, I want to just emphasize here this value, this style bias. We run our global portfolios along regional and style lines. We want blends regionally, so we're always going to be invested globally, and we want blends by style, growth, value, quality, a blend, and then some emerging markets which are blended. And you can see we already have quite a significant amount in value. We think that's likely to be the best performing area this year. These are the sort of stocks that are going to benefit from this ongoing recovery. And then there's the performance of the two funds. This is to the end of December. We haven't got the January numbers yet. It's going to be a down month. There's no doubt about that. But let's see when we get the numbers. And with that, I will stop my screen sharing and hand on to Mike.
Glyn, thank you very much for that. And just while you had the slides of the Brenthurst Global Balanced Fund, I did some work on the performance relative to the very large and popular balanced funds in South Africa. Glyn, your fund has returned over 10 years, 13.9% per annum. And if I compare that with all of our balanced funds in South Africa, you've beaten them by about 3 to 4 percentage points per annum. So that's turned out to be a very, very safe diversifier with a nice offshore component with very low volatility. So well done from me and all our clients.
That's nice.
Thanks,
That's very nice. I'm pleased to hear that. Thanks.
Thank you. Mike, over to you. And the one question that's already being asked, maybe you'll touch on it, is this news of this massive loans that South Africa is going to borrow in the next year. We're talking about $40 billion. So while you're talking, can you think of an answer that makes any sense? So over to you, Mike.
Okay, I'll try and answer that. I saw $750 million, but who knows? Everything is but open at the moment. But let's put it this way. I'm quickly going to go through two parts, or a presentation from two parts. And the first part, I'm going to just have a look at fixed investment, which is not the investment that you as an investor do, but it's a more permanent type of investment. I wrote about it in the latest Brenthurst Wealth Management thing, and it's only going to be about 7 slides. So it's just a summary of where we are and why people are not investing their long-term capital in South Africa. And then the second part, I'm going to be looking at that high inflation. And I also think interest rates are rising, but it will be slower because central banks are going to be super careful. And I'll try and answer some of the questions and some of the things that Magnus and Glyn have been saying, and even Magda. Independently, I came to the conclusion that it's maybe time for more value type stocks. But if we look at the first part of this, and I'll start with something, this is called the internal rate of return, but it's by economies, not companies, but it's the same thing. And instead of looking at the weighted cost of capital, you're looking at the weighted cost by inflation of capital, for example. And it's all standardized. This is up till 2020. So it's always going to be about a year behind. There's a lot of people that work on this. But you can see here that the developing market average is about 12.5%, whereas the advanced economies are around about 8.3%, which is why in the fixed investment sense, the money is moving from companies in the United States or Germany or Japan into the more developing countries where they then expect better returns. South Africa, unfortunately, has got a return that's closer to the advanced countries, which is a concern because developing countries are obviously a bit more risky. So they need that higher return. And because we don't have that, it's a huge problem, I think, for South Africa to attract capital. You will see the world's 2 biggest economies, although China is still an emerging market, it has a bit of a less of a return than the advanced, but China is just so big because that's the other thing that one must look at. And then you can see some of our neighbors like Lesotho are very much lower than us. And our other neighbors aren't that much higher except for Namibia and Botswana. But why do we look at this? Well, the returns, as you can see here, that the private sector gets encourages fixed investment. And here what I've done is I've taken the 4-quarter average return that that companies at the private sector got in South Africa, and I've lagged fixed investment by 4 quarters. So what it shows me is that fixed investment reacts to what's happening in the profits of companies. And that just makes sense because without profits, why would you invest more? And if those profits, these profits here I'm looking at, I take away the money market rate. So a company can put the money into the money market and they could earn, say, 3%. If their return is 6%, they have an average return of 3%. And that's one of the reasons why we've gone up. The interest rates are so low, but it is starting to impact the fixed investment in South Africa. We must just remember, however, that fixed investment in the last few years for South Africa has declined significantly. And you can see they declined with over 20%. And in fact, it's still, the latest number was still a decline on a decline. And therefore, fixed investment in South Africa as a percentage of GDP has declined. If we look at that same fixed investment or that private sector asset returns, you can see how it gels together with the employment growth or the amount of people as a population, because that population needs a job. And you can see how that's declined along with the negative or the decline in private sector returns. And that leads me to the next slide. This is just the same principle. We look at the fixed investment across, or the growth across the world. And that's one of the other factors that will influence fixed investment. And here you can see there are a number of African countries that have done well over the last 10 years. Ethiopia has grown with 255%, Kenya with 125%. At the bottom, however, you'll find in the last decade, South Africa only grew just less than 16%. That's less than advanced countries did. Even our troubled neighbors like Namibia and Mozambique have outperformed us. If we go a little bit further to Mauritius, you're looking at, it wasn't brilliant for Mauritius maybe, but they still had around 3 times the growth that we did. Same with Botswana. Then you look at China, which wasn't the best decade either for China, but it's just over 4 times our sort of growth. And then you look at the Rwandas and those sort of countries where you're looking at 6 times the growth rate of the South Africa. You can see we're not the last, but we're certainly at the bottom end of this. There are other advanced economies that also struggle with this, like the Mediterranean countries, Portugal, Spain, and the like. So this is where we're not doing well. The next slide for me is or for us here is fixed investment, just to put us where we are. And the world in the last decade has had a fixed investment to GDP ratio of 23%. South Africa has been 19.4%. The latest number for South Africa is much closer to 13%. The last year is much like 15%. So 16 is under 16% for South Africa. So we're really lagging. And if we look at the developing countries, they had around 25 or even more percent and so on. And that creates jobs. So if you're at 19%, and we must remember 2011 and 12 were still good years for South Africa, then you must know how badly we've been doing now. And I'll show that with the next slide to us. You can see that from 1960, the private sector has been significantly investing into the country. So did government until the mid-80s. And then general government started declining. And this general government includes the state-owned enterprises. And it's at its weakest level ever. And if you believe in the future of a country, you believe in the future of South Africa, you invest in it. Well, the problem is government does not believe in the future of the country. And yes, certainly the pandemic had an influence on the private sector, but still that's a very, very low number, under 10%. For but the second time since democracy from the private sector, and especially the beginning of democracy, I think the private sector was a bit worried. What will happen? Will we go into communism? What is the ANC going to do? So they held back. Then they came back on board, and you can see in the run-up to the 2010 Olympics or soccer in South Africa, how everybody started investing. Government at the moment is not even investing effectively, and it's investing less than it's ever done. And that tells me that government has no idea how to fix the economy. And that is another factor that we've got to keep in mind. My last slide on this, and then we'll head into the more investor type thing. And this is a real big indictment on South Africa, is we are the only emerging market where more of our companies invest into other countries than those other countries invest in us. And that's despite the fact that some of our companies have gone overseas totally, and then their investments are captured as foreign investors, such as, for example, Anglo-American primary listing is now in the UK, or Richmond and so on. That is a real indictment on us. And to have $118 billion US more invested outside the country, and this is fixed investment, so that really means we've seen it's literally a job outflow. I reckon it's at least 3 million jobs that have left South Africa in the last 3 decades. Maybe it's not really jobs that left. It's just that money could have gone towards jobs in South Africa. So we've got this situation in South Africa where the developed markets supply capital to the emerging markets, but we are the 9th biggest supplier of capital to the rest of the world. It's incredible for a small country, and it says to you that I've showed you that government doesn't believe in the future. They don't. They can talk investment, but they don't invest. This shows you that the private sector and the foreign sector can say what they want at our investment conferences. They are not investing. They are basically lying to us. And the thing is very crazy because it's funny to hear, yes, we're attracting investment, we're going to do this. All the things we see are actually very small ones, other than in mining and agriculture, and I would say probably the motor industry because of the subsidies, the security industry because of the crime here. It's an attractive industry for some. But I think outside of that, we've done very, very poorly, and we are not able to attract the investment. I'm going to quickly do the financial side. The first thing, I've got the same growth charts, but you can see here that it's definitely down on last year. A lot more people are looking at a slower growth, whether it be the IMF or the World Bank and all these other private places. And next year will be probably even slower. I think the IMF with its 3.8 is probably at the high side here. We see most players around 3%. And the first few that we've got for 2024 show a similar, if not slightly slower growth coming in 2024. Which makes me think that while we're not going to see that great growth, what is going to happen to inflation? And that's the other thing. World inflation, as measured by the World Bank by weighting, has risen to a 25-year, 30-year high. It is really rocketed up. It may have peaked because the world money supply peaked before then, but world money supply is still around the 8% mark. So it's not quite over yet. It is still, we're still printing money quite rapidly in the world today. If we look at export prices, that's like your commodity prices as well. They've really risen a lot, and they've been one of the causes of that world inflation. I'm not here to convince you of otherwise, but I think at 30-year highs, it's not going to be just a transitionary phase. I think it's going to take, it'll come down, it's probably peaked, but it'll take a lot longer than most people realize. And you add a supply chain that's broken. Now, this is an interesting slide in that it shows the world, the global supply chain pressure index from the New York Fed. And it shows as that rises, there are other inflationary pressures that come. And for example, factories that don't get their stuff on time still need to make up capital and so on. So this is the Chinese PPI, and China is the world's factory. So at least goods are going to get a lot more expensive because they've peaked above 10%. That's on the left-hand side that you see. So if the world's factory, because China makes about 30% of the world's products, is not is functioning at a much higher level of prices, that will blow into the rest of the world at some stage, and that will be soon. That's the first thing. The second thing is there's a lot of localization policies now after COVID. A lot of governments around the world are trying to focus their industries to invest in their countries and to sort of replace imports if possible, because they think that if a COVID comes back and you have the supply chain reaction again, you've at least got most of these products. South Africa is also trying it. And that's normally a danger sign to inflation. And that's been proven time and again to be an inflationary environment. So both the fact that China is increasing, and that's also factories waiting for things, that's factories not being able to open at times due to COVID, but still they have to somehow survive, and they've got the thing. Then the world supply chain problems, I think, are coming down a bit. You can see the ships at anchor in a rolling 1 month is now down to 125 vessels, still above you, still above the normal, but it's easing. Part of that easing is obviously seasonal because there's no more Christmas rush right now. But where we were at a high of 17.5 days, we're looking at 11 days and a half days. Before then, we were looking at probably less than 5 days. So there is still a problem, but there are signs of hope here. But let's look what the money printing did. If you just look at the world supply of money from 97 countries, most of them, that increased at a tremendous rate. And just around 5 years ago or 6 years ago, the M2 has doubled the amount of money. And that has led to stock market returns. This is the world MSCI, just the price returns, nothing with dividends. And you can see how these two correlate. And this time around, the world money supply drew it up quite literally. And I think if you look at the broader one, we don't have a broader one for the world, but it's been said that the money supply in the M3 and the M4 has more than doubled in about 2.5, 3 years. So that gives you an idea that the money floating around the world increased at a rapid rate. It had to go somewhere. Some of it went to Bitcoin. Not so much. Bitcoin was never more than 2 trillion, or those or it was a bit more than 2 trillion, but not much more. Some of it went into metal prices. You can see the Economist metals index of when it's an inverse on the left side. So when you have negative interest rates, that pulls up, and it's going to remain benign. I think there will be positive interest rates, but not immediately. And so commodities, I think, will peak. Here's the electricity prices. Now, this is the strangest thing. Everybody told us when we go solar and when we go wind and so on, this is going to help the world, and it's not just clean energy, but it's cheaper energy. Well, Europe is finding out that that is not the case. They've seen here January 2020 is equal to 100. And you can see since January 2020, we're now 5 times the price, more or less. And these are 22 European markets that have daily prices, and Germany, which has a different price setting, but also daily prices. So here we're looking at something where the energy prices, and it doesn't look like this part of the energy. Yes, the oil might come down, but there are also things there. OPEC cartel is holding with Russia. They're holding the oil markets, the gas markets are up. Energy prices are a worldwide problem, and they are used in factories, they're used everywhere. Another reason perhaps why the PPIs of the world are starting to head up in places like China. Then is the central bank, are the central banks of the world really going to raise rates? Well, the UK did it 2 months ago. The United States last hiked 5.5 years ago, same with Canada. Europe 10 years ago, 10.5 years ago was the last time that the European Central Bank hiked rates. And then in Japan, it's 15 years ago. So I think the world banks, the central banks, are not going to move as quickly as people think. But when they are being caught out, and they're going to lose credibility. And once they lose credibility, and they're starting to lose it, they are going to have to play a catch-up game. And I specifically here left out the developing world because they've been more active. So that's very interesting how long rates have not risen. And if you were in the interest rate game and being a bit more conservative, I was too, it's really terrible that these guys just haven't moved. And the savers of the world, I think, will have noticed that. The next thing is a very interesting slide. I showed it once before, I think. This is the amount of that equities make up of financial assets. Of total assets, they're about 40, the equities make up 41% of financial assets. Of total assets, they make up about 20% odd, 25%. That's now including houses. And here you can see the average since 2000 was 30.5%. So it's certainly an upward trend. If you go back further, it will fall under 10% that equities. And then at the same time, you can see the real S&P 500 if you take away the impact of inflation. So apart from that we were printing money, people saw that the central banks were doing nothing in the last few years, and they poured their money in from about a low of 30% to, or just below the 30% mark, to just over the 40% mark. So they added another third of their assets to the equity markets. As the equity markets increased, obviously, but they didn't put money in interest rates anymore, and they've definitely increased their exposure to equities. And very often you have to see what other people do. And I'm of the opinion that this will stay high for a while, but you've got to be careful where people go to now. And as we've been talking about, the market being very jittery, here's the equity put call ratio. And that's in dangerously low territory where it could impact the investments on a year ago. And we already know that Nasdaq is now negative for this year. It's not negative on a year ago yet, but it's very likely to be at this sort of level where people were just too over optimistic. The split between the dividend yield and the S&P price return, again, the Schiller real price return, you can see it's been a very long, basically upward period. Yes, it's jittery. It's been very dominant now, but the dividend, the real dividend after inflation, is at its lowest level since the early 80s. And that's typically when you get to a slower moving equity market at stages. It'll last a year or two, perhaps. But the other thing is that other things like commodities and so on can move. But along with that, and that's what Magnus spoke about right in the beginning, I don't know, we didn't talk about my presentation and his presentation, I swear. But here's the Russell, they've got, it's the Russell 2000 as the company, and then the top 200 value index and the top 200 growth index. And you can see it's been a very much a growth story. So the growth has been outperforming value here for a long time period on this way down. So right now, value is undervalued. And we believe that it will come back like it did after 2000 when the Nasdaq fell. And well, that's what I believe. And it went from about 65% of the value that the growth stocks had, right through to where it went over 1.5 times what the growth stocks had. So that was a very big shift. And then over a long period of time, since about 2008, value has been thrown under the bus in favor of growth. There's not much more that growth can do here. It can go a little bit, but we're now at the lowest level since this index is available. So it is definitely something that tells me that we've got to look at. So, sorry, I did the wrong slide. If you look at this, it's again the same index, but here's just the real value, the actual index numbers. And you can see in a short period from the end of the 90s to 2002 or 2001, the growth went up tremendously and value did nothing. And then growth came down and value still did nothing, didn't decline. So you wanted to be in value. Remember, then the value would have the dividend growth and so on. And then for a period of time, value took over during the commodity boom from 2001, 2002 till about 2008. It still held its value better, I think, for some time, other than in the actual 2009 year. And then it tracked up. But after that, when the commodity boom completely finished and everything, there was a clear move with the printing of money and so on that we saw in 2002, 2001. I mean, 2020, 2021, right at the end here, sorry, how that's gone up. But now you can see the corrections started coming through in the growth stocks. The growth stocks have gone and they've dropped virtually 10%. Again, the value stocks haven't seen that drop. They're still tending a little bit upwards. And I think I'd like to ask Glyn and Magda what they feel, but this gives me a very big hope for the future. It's a better place to invest in gold, probably, because there's more investment opportunities here. So I think we're heading for a more value-oriented thing. And then I just want to finish with one thought. I don't have evidence of this directly, but I have some, but I haven't finished it quite. That your hedge funds, it can go both ways, long and short, and that are more market neutral between, say, value and growth situation. It's them that could, in a time period like this, actually make hay. And it's obviously a bit more risky, but it's what I think will happen. And that I'll leave and I'll stop the sharing of my screen and hand everybody back to Magda.
Well, thanks very much for that. We don't have much time for questions. There are a couple of questions that have come through. I think we've answered some of them during our presentations. People are very, very welcome to write to me directly at invest@brenterswealth.co.za, and we'll try and get them answered. I just want to thank our three speakers. I mean, as Mike said, we haven't briefed each other what to say. We said it's your show. You can say what you like. And so if I may summarize, from Magda's perspective, and I agree, downturns like this, anything that goes down 30 or 40% suddenly looks very attractive to me. I mean, whether it's tech stocks or fourth industrial revolution. The second point, people are asking where can they get hold of, the private equity stuff like OSI and Bravos. Magda, you might want to just answer that very briefly, but we've been very successful in placing large amounts for our clients in both OSI and Bravos. Maybe just comment on that, Magda.
Absolutely. So Signia OSI fund, and we need to rename it OSC since the company renamed to OSC, but that's endowment policy sold through Signia Life. And then that policy invests in the Bravos funds, which then invest, which are venture capital funds, investing in, among others, the OSC shares and the spinouts coming out of Oxford University. Now, those Bravos funds, if you have money offshore, you can access directly, and those funds are registered in Guernsey. So there's absolutely no limit, if you can take money out under your 1 million rand capacity or 10 million rand capacity and invest directly in Bravos. Alternatively, in terms of Signia OSI fund, OSC fund, on the Signia Lifelines and the Signia banner, we will make that fund periodically available as we have offshore capacity, because as you are acutely aware, we all are placed under limits by SARB in terms of how much money we can externalize offshore. And like every single other asset manager in South Africa, we have reached, close to the limit that we are permitted as an institution to take offshore on behalf of our investors. And since Signia OSE fund is 100% offshore, it's strictly subject to those limits. So we will make that fund periodically available and opened. But in the meantime, if you want to invest, there's absolutely nothing stopping you from using your, say, 1 million rent allowance and investing it directly in Bravos funds. That's not a contravention of anything. I can also talk about the Bravos funds directly in South Africa because Bravos has a Category 2 license in South Africa now. So there's nothing, and so we licensed by FSCA in South Africa and FCA in the UK.
I can just add, Magda, thanks for that. That each of my my children, I put some money into the OSI funds, and I said, you don't touch that for 20 years. So I like what I'm seeing on the OSI and Bravos. So anybody interested in information about those two funds, very welcome to approach one of the 9 officers of Brenthurst. But we're running out of time. I would like to really thank our speakers. Glyn, very nice chatting to you. You're doing great fun stuff with our funds. Keep it up. Mike has been our consulting economist for a year. He's not afraid to speak his mind. He talks it as he sees it, and we like that. Our clients like it. And to Magda, we have a great relationship with her and Signia, and we have to do some great stuff in the future. To all our clients listening, to our non-clients who found it interesting, and to the marketing team of Brenthurst, Dalian van Wyk and Sue Heystek, for putting this together. We had more than 1,000 bookings. We had about 800 people listening, which is quite tremendous for South Africa. So I'd like to thank you all and have a very, very pleasant February coming forward. And happy Valentine's Day to all the ladies. Cheerio from me and goodbye.
Thank you. Bye.
Bye.